All right, friends, Jedi options. Let me not bury the lead. We're going to take a look at Google, and the general concept here is trading a stock after earnings, trying to take advantage of a continuation of the volatility crush. Okay, so you come across this situation 4 times a year, right? You got your quarterly earnings. And often the question is, well, if a company reports earnings and it responds, the stock jumps up or down or whatever, how long do I have to wait before I enter a trade? Well, here's a situation where you can enter a trade the day after the earnings announcement, right? Google reported last night, or Alphabet, if you will. And today is the response to that earnings announcement. And I'm going to show you some analysis and a potential trade example on Google again today. So there's a couple of dynamics, I think, that you need to understand that support this particular trade idea. Let's start with the trade setup, the chart, build a technical case, and then I'll get into the option dynamics. If you take a look at the chart of Google, we've already talked about this company. Google's up, I think, like 69% year to date, just bananas. Had a fantastic earnings report per Matt's earlier comments. But more important, maybe most important for me, is the technical pattern looks great. Google's been going sideways for 2 months, recently tried to start an uptrend to get back to the upper end of the range, and you're seeing a potential breakout today on volume with good fundamentals that it's back. You can make a pretty compelling technical case. If you want to build it even further, you go to the weekly chart and you just say, hey, let's look at all these previous weekly breakouts. Show me when it was smart to bet against these weekly breakouts. Typically, you get follow through. Google has taught us again and again and again that you trade with the trend, look for excuses to buy versus excuses to sell, et cetera, et cetera. So I like the weekly pattern as well. I think you got sound technical footing for building a bullish trade. Now, what kind of bullish trade do I want to do? Well, in this particular situation, I'm going to err on the side of doing a high probability trade, a cash flow type trade, specifically designed to take advantage for any extra squeeze that's left in the what we call volatility crush. So you got to understand a little bit about how implied volatility works to get this concept of volatility crush. Conceptually, implied volatility tells you if options are cheap or expensive. And what you discover is over time, there's a pattern, a cycle that tends to play out around these earnings announcements, whereby options get expensive in anticipation of earnings, and then they get cheaper afterwards. And the logic here is pretty straightforward. You're willing to pay more for an option ahead of earnings because you expect the stock to move a lot. Earnings are catalysts that increase the actual volatility of the stock, and options are forward-looking. They're smart. They price that in. People willingly pay more for calls and puts ahead of earnings. That manifests itself as a rise or an increase in implied volatility. So the general idea is IV goes up into the announcement. And then once the announcement happens, once the catalyst is come and gone, normally the stock reverts back to its normal movement, its normal volatility. There's no more reason to have these bid up option prices. So they get cheaper. They go back to normal. And usually they do that very fast. If you think about it, the day before earnings, there's tons of potential for what the stock could do. The day after earnings, that's it. Cat's out of the bag, no more announcement, no more catalyst. So options rapidly go back to pricing in normal volatility. So you see this big drop in IV. So the cycle is a long build into earnings and then a crush afterwards, and a long build into earnings and a crush afterwards. Why isn't it perfect? Like when I look at the chart of Google, I don't see a perfect rise and fall every 3 months. There's a lot of messiness as well. The reason for that is Google is not trading in a vacuum. Google is influenced by broad market trends. So sometimes what the overall stock market is doing will trump that cycle. For instance, if the stock market crashes, even if Google doesn't have an earnings announcement coming up, options on Google are going to get more expensive because the market's going crazy. And so those exogenous events that have nothing to do with Google earnings and the Google earnings cycle can cause disruptions in the normal volatility cycle. This last quarter, the cycle played out fairly orderly. You can see last earnings announcement. Here's the volatility crush. Options getting cheaper after earnings. And then, 6 weeks go by, and then you get 6 weeks, within 6 weeks of the next earnings. And in general, the IV kind of works its way up until the next earnings announcement. And then it goes back down, right? So what we are witnessing today on Google is a volatility crush. Options on Google are getting cheaper as we speak because they're pricing out that earnings move. Okay, so I want to sell options because I think that this will continue. I think this crush could continue. Most of it happens overnight. By the time the market opens, they kind of price it out. But throughout the day the day after earnings, you continue to see kind of a vol crush. So, we're a couple hours into the trading session. I can tell you this trade would have been better this morning had we entered earlier, in part because the vol was higher and in part because Google was lower. And so entering a bullish trade earlier today would have been slightly better. Nonetheless, I still think we can build something here. So what is a strategy that allows you to profit from that vol crush? The answer is, selling puts or selling put spreads. Google's so expensive, we're not going to sell a naked put here. We're going to do a bull put spread. And one of the reasons why I think Google is well suited for a bull put in particular right now is if I were to build a bull call spread, there's not a lot of strikes to choose from. You have to do a 50-point spread. If I'm going to do a bull call above the current stock price, I guess you could do a 20-point spread here, but then it goes in $50 increments. So that's an expensive trade. When I look at the put strikes, they're every $5, which makes me have more flexibility in creating a bull put. And I was going to maybe compare doing November to December, but December options do not have $5 increments. When I look at the strikes that I need to build this, they're $50 increments. So that's a little bit too tough. So process of elimination, I think you have to build using November options, which are front month. And essentially what I want to do is I want to make a bet that this breakout sticks. I want to make a bet that today's rally sticks and that we don't go back below essentially today's low. Now, earlier before this session started, I was trying to get down around the pivot low, selling a bull put down there. But we've continued to go up so much throughout the day that I now have to lift that up a little bit and be more so around like 27.75 or so. So if you're willing to bet Google doesn't break today's low over the next, say, 2 or 3 weeks, this bull put spread will pay out. And essentially all I'm going to do is go as far out of the money as I can, but still get about a 10% return. So if you look at what's available, I want to be down around that 27.70, 27.80. The delta's around 13, 14, 12, somewhere around there. Let's start with a 27.75. I'm going to sell that put, and then I'm going to buy the 27.70. Now that's trading for 45 cents. I want 50 cents on a $5 spread. So I got to raise the strike price. I'm going to go 27.80, 27.75. It's 55 cents. Now, assuming I can get filled at 55 cents, because the bid-ask spreads on this are kind of wide. That's my little disclaimer for Google. Google options are a little tricky sometimes to get filled at. So if you're a stickler on liquidity, you might want to pass on this. But the more important piece to me is this conceptually, how we came to this conclusion, how we built the trade. You can apply this on other more liquid products. But to round it out, 27.80, 27.75 bull put spread, getting 55 cents. I don't really have the time to go through all the nuts and bolts of how a bull put spread works, but you're essentially risking 445 to make 55 bucks. You're going to drastically cut the risk though by just getting stopped out if Google breaks below 27.80. And that essentially corresponds with, well, today's low is 27.88, right? So you're about 10 bucks below today's low. And the two things that will help is, well, three things actually. If Google continues to rise, which based on the trend it should, you'll make money. If time just passes and Google just goes sideways, this bull put spread is going to make money. And more to the point of today's class here and lesson, if implied volatility continues to come down, that's going to shrink the value of these out of the money puts and push that bull put spread towards zero, so you can more quickly capture that 55-cent gain. Okay, so to sum up, you got the implied volatility cycle. We're on our way down with IV. Going to capitalize on the continuation of that crush. Admittedly, would have been better to have done this 3 hours ago, but I still think this thing will come down. I like the breakout. It gives me the confidence of leaning slightly bullish on Google, but I'm not going for the gusto with a bull call because I don't like the $50 increments. A little too expensive for my taste. So I think the bull put's the way to go.